Hi, welcome to another edition of Digital Conversations under the Flexpo Plus banner. As you know, our goal was to organize Flexpo Plus and relaunch the conference this year in person, but because of COVID, we've had to cancel that. We're hoping to do that in-person event next year. Meanwhile, for this year, we had a great slate of speakers that had agreed to speak at Flexpo Plus. So we reached out to them and requested digital conversations, and that's the reason why we are here. We have a terrific set of panelists today. We have Brian Orkin from Arsenal Capital Partners and Chris Childress from Edgewater. We are looking forward to our conversation with them to learn a little bit more about private equity investing, in particular in the chemical space. So without much ado, let's get started. Chris and Brian, welcome. Thank you for making time. Today, we really appreciate you guys taking some time out. I know you guys are super busy, so this is particularly helpful. Thank you. Maybe can we start off with a quick introduction to yourself and your company? Brian, maybe we'll start with you. If you can tell us a little bit about yourself, about Arsenal, and also, I guess, how did you get into private equity investing focused in chemicals, right? I mean, it's still a fairly small specialized segment, and I'm curious how both of you guys got started. So Brian.
Yeah, sure. Uday, thank you for having Chris and I here to talk about investing in chemicals. It's good to see you. My name is Brian Orkin. I'm an investment partner at Arsenal Capital. We are a mid-market private equity fund based in New York City. It's a specialist fund focused on two verticals. I'm a partner on our team that invests in specialty industrials and more narrowly around chemicals and materials, and the other side of our fund does healthcare. We're investing out of our fifth fund, which is a $2.4 billion fund. As far as me personally, I have somewhat of a non-traditional background for private equity, which will be similar to Chris's in many respects, as you'll soon hear. In my 25 years of industry, my first 7, I was an M&A lawyer in firms in California and Pennsylvania, doing M&A deals for private equity funds, among other, entities. Then I switched over to private equity 18 years ago. I've been with Arsenal for 11 of those 18, the last 11. And again, how I got into chemicals investing, candidly, is by virtue of when I joined Arsenal. That's what Arsenal did. So I was a generalist deal guy in many respects by both education as well as experience, and then became more specialized as the Arsenal model, where we're focused on a few verticals and being very deep in those. And many of my partners all are operators who have come out of the chemical industry specifically. As a result, we have an integrated investment model of investment folks like myself, but then more than half of our team are industry and operating folks. So as a result, I sort of learned everything about the chemical industry by hands-on investing over the last 11 years.
And excellent, that's helpful. Can you talk a little bit about Arsenal, Brian? What have you guys been working on? What are some recent deals that you've worked on? Just a quick introduction to Arsenal would also be helpful.
Yeah, sure. So our focus, as I mentioned, around being focused on two verticals, again, within the chemicals and materials vertical, where I focus my time, we really focus on what we think of as specialty chemicals and engineered and formulated materials. So that's sort of a mouthful. I think the specialty chemicals side is somewhat self-evident, where you're taking sort of raw material inputs and then further processing, refining them, cracking them, whatever the case, and essentially selling them for performance attributes rather than meeting a specific spec. And I know Chris and his partners do a lot of that same type of investing. And then we sometimes go further down the chain into more of these formulated materials, whether adhesives, paints, coatings, things like that, and even further into plastics, films, composites, foams. Those are, for us, engineered or formulated materials, and finally into sort of processed or engineered parts, things like plastics and and other related materials. So we focus on that entire sort of supply and value chain, again, oriented more towards specialty type businesses, both from a product but also a business model, rather than sort of big asset intensive, more commodity type chemicals, which, by the way, private equity has a long history of investing and investing successfully in those types of businesses. That's just not what we do.
Thanks, Brian. That's helpful. Chris, so maybe if you can quickly introduce Edgewater, talk a little bit about your background and how you got into this space, that would be helpful.
Sure. Actually, quite, not ironically, but interestingly, very similar to Brian. Between university, just after university, I worked in a couple of different finance jobs, Merrill Lynch and Arthur Andersen, and this is a long, long time ago. Was not really on a very successful career track at either of them, and went to law school, studied mainly and looked and was recruited mainly for corporate law jobs, took a job on Wall Street in an M&A and security shop, realized quite quickly I was not going to be on a career track there either. Went to the Midwest to work for what you'd characterize now as an unfunded sponsor, although we didn't know to call it that back then. Working effectively on really heavy automotive turnarounds, commodity manufacturing, pure commodity, make door hinges, think window seals, think door panels. Buying businesses with solid heavy asset plants, 40, 50 million of sales, 0 to negative earnings. And, we would buy them with a very small equity contribution and a heck of a lot of debt. It's a kind of model that would work 1 out of every 10 times, but the one that worked would be sort of an infinite return because the equity was effectively negative. Our fees were larger than our equity contribution. But with the automotives getting very aggressive with productivity givebacks, with the Asian supply chains coming online in the 90s, I made a conscious, and the folks I was working for and with actually had a series of simultaneous events, which led one to retire, one to leave, and actually one unfortunately passed. I was reading a lot of Warren Buffett. I was really focusing on I was located in Cleveland. I'd grown up, lived in New York my whole life, and really became focused on businesses with high barriers to competition, high cost of failure, high unit economics, technical sale processes, businesses that couldn't be yanked into an OEM, couldn't be bankrupted by the customer because they wanted a half a point off the cost, businesses that couldn't be resourced to Asia easily. And Cleveland was a good, had TRW, it had Sherwin-Williams, had a bunch of small middle market and other middle market businesses. I liked the lower middle market, which is a difference between Edgewater and Arsenal. We really focus on smaller earnings businesses under 20 million in EBITDA, where we frequently are the only private equity specialist chasing the transaction. But it really came into initially specialty chemicals, and then very much like Brian and Arsenal into specialty industrials. Our verticals are specialty chemicals, life sciences, engineered components, and engineered materials. And it's the same thing. We want to be a small unit cost of the overall product, right? But we want to be mission critical. So think of a nozzle on a missile. Think of a ceramic specialty turbocharger inside a drone, right? Those things cost 1% of 1% of the final cost, but if they fail, the whole thing goes out the window. Think of a polymer that goes into a carbon fiber that makes it flexible, that goes into a engine fan blade, right? That doesn't flex, the engine deteriorates, blows up. That polymer is tiny in terms of cost, but if it fails, everything fails. The best summary I ever heard is we look for products that are businesses that manufacture products or distribute products or develop products that are purchased for what they do, how they perform, not what they are, how much they, made to spec and what their cost is. I guess I'm jumping from me personally. I founded Edgewater Capital Partners in 1998. I was a one guy with a free office space in a law firm. And, it's built now. Again, we're lower middle market. We only manage just under 300 million. But we have 20 people, Only 4 of them are operating partners, but each one owns a specific vertical in one of our, a specific market vertical for what we do. And you know, I do remain excited about private equity and continuing to work. It's why I am still working.
Thanks.
That's me in a nutshell. You want to talk about Edgewater a little bit? I've already sort of, the Venn diagram sort of merging a little bit in terms of what I'm talking about, but you know, Edgewater Capital, again, I've talked about our strategy. We have 21 people. We have 5 degreed experts in material science, engineered components, specialty chemicals, and life sciences. You know, former CEO of Cambridge Labs, former CEO of a middle market specialty chemical company, former business director for a $1 billion operation at Saint-Gobain, former Roman Haas executive. You know, we have been investing solely in this space for 22 years. We don't step outside. Very much like Arsenal, we think that our expertise in our sitting solely in this space provides us with an advantage in certain processes in our verticals, particularly where the business, and particularly in the lower middle market, is a really difficult carve out. You know, where a generalist might stumble in terms of getting to a successful resolution for the strategic seller, where the strategic seller may not want transition service agreements. The strategic seller may not be able to sell to a generalist. You know, we've done carve outs where we had to build the plant because the seller wanted to sell the product line in a non-compete, but didn't want to sell the manufacturing. So part of diligence, we had to form, we had to sign a tolling agreement for 1 year and then build a plant and have it qualified in a year. And we've done things as crazy as that. And then we've done really minor carve outs where we just had to hire a CEO and a CFO. You know, we've been obviously very successful, as has Brian and Arsenal. You know, we continue to grow up and get bigger, but you know, we like to think of ourselves as differentiated insofar as, you know, most of the time when we're chasing a business, 10, 15 million in EBITDA, we're the only subject matter experts from a private equity perspective looking at it. Now, I will confess that we have seen the Arsenals and the Audexes, and I'm not, Arsenal actually is sort of the middle market expert in this space, but we, every once in a while, Brian, when you guys looking at add-on acquisitions, we do see you coming down into our territory, which is, you know, not something I had to deal with 10 years, frankly, but that's okay.
But as you also know, we also buy some of your businesses.
Yeah, exactly. Yeah, which
and are willing to pay full market clearing price for them as well.
Very much so. Yeah, and there's no complaints as to my career here, believe me, or to where Edgewater is. But you know, generally, it's a community, and you know, there's a lot of transparency between what I would characterize as the differentiated industrial. A lot of transparency and collegiality among the differentiated, what I would characterize, and there's not that many of them, differentiated private equity groups which have, you know, if you go to these, if you go to conferences on fund investing and fundraising, everybody talks about operating partners, everybody talks about industry expertise, but what they're really saying is, well, we're always the smartest guy in the room. And what I would say about groups like Edgewater and Arsenal is I don't know that we believe we're the smartest guy in the room, but we believe that there's not been a stone left unturned in terms of our expertise in addressing our market. We know as much as we can, given our resources, about our specific verticals. We don't go outside our knitting. And that means when we are sitting in the room, we may not be the most smartest, but we will have the knowledge of the market and the industry and the company that we say we do. And that does provide a differentiated experience for the seller, and should give the seller much more confidence in both closing and in both a successful outcome to get to closing and post-closing. There won't be a problem that comes back to bite them from a indemnification or lawsuit perspective.
Yeah.
So again, I'm going way off subject, but I hope that.
No worries, Chris. That's helpful. But you make a good point, right? Brian, I was at the conference that you chaired, I think, right around this time last year. And one of the most interesting things to me was like how collegial the atmosphere was. Although, right, I mean, there were a lot of firms there that were active in the same space, but it didn't feel like a very competitive atmosphere, right? It felt like a very collaborative atmosphere. And I want to come back to that a little bit when we switch over to talk about private equity in general. But Let's talk a little bit about COVID, right? We can't have a conversation this year without talking about what COVID has done to all of our businesses. But I want to understand a little bit how COVID has impacted the business of private equity, right? What's happening to deal flows? How have you guys been going about investing? So Brian, maybe we'll start with you.
Yeah, sure. And I think, and I'll circle back and answer that question specifically, but Chris raised an issue around differentiation I think is important that has really manifested itself during COVID. And I think that's a perfect example of what Chris was talking to about, sort of not necessarily being the smartest people in the room, but having a been there, done that mentality or understanding of the businesses that we're overseeing and that we own. And as a result, you're better prepared to deal with things and sort of make adjustments on the fly because you are in a comfort zone that by knowledge of both the industry, but the specific business that you couldn't otherwise bring to the table if you're just literally learning about the business after you own it. And COVID is to me the perfect example of where that strategy sort of pays off and bears fruit because, I think when COVID, go think back to late February, early March, things were just starting to sort of unwind. The way I think about how we at Arsenal sort of dealt with things was in some respects similar to kind of the evolution of the virus, which is it kind of happened in phases, right? I mean, when you think back, it's easy now in October to start looking forward and think about what it looks like on the other side. We've probably been doing that for a few months, but back in, late March, early April, I mean, there were discussions going and no one knew what was going to happen. And there was an incredible amount of fear, I would say, in the marketplace generally about the economy, about the health and welfare of the world or, the community, whatever sort of lens you're looking at it through. And so, at Arsenal, what we did is the naturally prudent thing in hindsight, but at the time wasn't so clear, which was focus internally almost immediately, right? We looked at our portfolio companies, first and foremost, and looked at them and did the typical sort of, took the action steps necessary, like many others, in terms of making sure liquidity was in place, drawing down revolvers, otherwise shoring up activities and focusing on the health and welfare of the employees. And, that it was not at the time, it wasn't clear that what was going to happen. So we spent probably, 2 months thereabouts focusing 100% internally, making sure everything was sort of under control to the extent it was. Now, in some respects, many of our businesses were deemed essential businesses, so they stayed open. But it was hard. And some of our other businesses made things like hand sanitizer and PPE. So there was a whole bunch of collaboration across our portfolio. Chris's earlier comment about operating partners. Our teams are embedded, generally speaking, with the companies, but even more so here, daily contact with our operating partners responsible for the operations of the companies. I mean, just constant dialogue. And again, at the very outset of this, it wasn't no one quite knew how bad it was. I mean, I think about some of the conversations early on around, the next depression as a base case, right? I mean, that was a very realistic and real consideration. As it turns out, 3-6 months later, probably back to maybe a different tone, different perspective. But I think, from our perspective, at least, again, bringing it full circle to Chris's earlier point, that sort of experience that we at the Arsenal level and Chris and his partners have around the companies we invest in really enabled us to deal with COVID. And as a result, the businesses have, for the most part, been resilient. There's pockets, as always, based in some industries that we serve where the markets are softer, but net, I think we feel optimistic and cautiously optimistic about coming out the back end, and if not a stronger position, certainly a strong position with the ability when the rebound comes to take advantage.
Mm-hmm. Thanks, Brian. Chris, how has COVID impacted your world, I guess, both from a portfolio point of view as well as from an investing point of view?
Well, very, very similar to Brian, and I think that very similar to Arsenal and echo, a lot of what he said. I guess to, certain particular experiences to Edgewater, and I think to private equity that I'd add to that were, from a business perspective, it's been very strange and in a lot of ways unpredictable. I think the fear in March was really about nobody knew what was coming next. There were a lot of doomsday scenarios going across the media, as there tend to be. And we actually had several processes ongoing that were either pulled, we had companies signed up under letter of intent that were pulled or that we terminated just out of, there's just no way we could predict for the lenders what was going to happen the next few quarters. Q2 was particularly strange because, we expected there to be significant opportunities, and I think not really from a quantifiable perspective, but just an instinctual perspective. Well, everything's going to hell, so maybe we'll be able to pick up some businesses at good valuations. But what actually happened is a bunch of sell processes got yanked out of the market, but the same amount of private equity was out there chasing. So there was at least in our experience, a very weird dynamic in Q2 where prices actually ticked up for good assets, and we have not seen that pull back yet. The lending market took a bit of a hit. Debt got a little more expensive, sort of a little bit of compression of earnings, but nothing like 08, 09. And again, deals are still getting done. They're still out there. They're still being chased, and they're still expensive. Internally to us, obviously our office went remote. We have not gone back to being remote. But we haven't missed a step in anything except I would say that, onboarding and new employees are having a tougher time than I think they would have. Getting them embedded in your culture with a virtual only model is pretty difficult. Portfolio, I'd echo what Brian said. We were very much embedded and very deep in Q2 in, and our businesses are smaller, so several of them were qualified for PPE. All of our businesses, our remaining portfolio, were deemed essential. So we didn't have anything really take it in the teeth. However, it was also an interesting dynamic. We have one business that makes blood products for healthcare, which you would think would go crazy, but because all the universities were shut down, all of their research and development product sales went to zero, right? Now, so you had ups and downs at various businesses, which you probably could have predicted, but it was very tough. Onshoring as a overall philosophy, as I'm sure you both know, India has been the premier, major growth area for pharmaceutical APIs, reagents, but they basically put out the public that they were nationalizing they were cutting off foreign exports. So that has led, and the Chinese dynamic and the supply chain worries have led to several of our businesses exploding from a pipeline perspective. And then at the same time, as I'm sure you guys are aware, the oil and gas market, our businesses with exposure to that have seen revenues compressed desperately. Yeah. Overall, we have stability and liquidity. We don't have anything ticking towards the edge, and we have a couple businesses where EBITDA prospects have increased remarkably. So it's been 08, 09. We felt sort of across, and I'm referring for anyone watching this who's under the age of 40, I guess, to the last Great Recession. In that period, our businesses were pretty resilient because specialty businesses tend to be resilient, but we did lose kind of across the board bit of revenue everywhere. Mm-hmm. Here, it's been very up and down. The strange dynamics of COVID is kind of this non-economically structural black swan have created very bizarre dynamics where there are sort of haves and have-nots in the industrial area. And the have-nots are hurting, but the haves, with onshoring and other stuff, are booming. So, I think that's all I can say about COVID. Our firm is doing well. Our pipeline is excellent. We are concerned with inflated asset values, but that's a song I've been singing since 1998. So.
That's helpful, Chris. So, as you know, right, we do a lot of due diligence work for sponsors and around transactions. And from what we are seeing, it seems like the traditional standalone acquisition activity seems to have slowed down a little bit, but the carve-outs and other larger chemical companies thinking more actively about their portfolios and exploring moves a little more quickly that seems to have picked up pace. Would you agree with that, or do you see deal flow being a little different? Brian, we'll start with you.
Deal flow is way more active than I would have predicted. And again, in hindsight, it makes some sense, but I still was off in my predictions. My view was the fall was going to be crickets because of the hangover of the pandemic, the economic slowdown. Takes a while for distressed M&A wave to work its way through Python, and then the overhang of an election. As it turns out, those are still, I would say maybe the economic contraction not as deep, but beyond, I think the other variables are still in play. Yet the opposite is happening. It is as robust a deal environment across all the different kind of types of deals as I've seen. I mean, it really is. And to Chris's earlier point, valuations have not moderated. And if I think about the buckets of kind of where deals come from, the corporate carve-out activity, very high. Private sellers now very active, both with the threat of, increased capital gains, but also similar to 08, 09, some people kind of throwing up their hands and saying, I don't want to deal with this anymore. Mm-hmm. And then thirdly, the private equity sellers, right? Chris and I, our funds are in the business of selling our business, monetizing our businesses, our investments at certain points. That activity is as robust as ever, right? Both from a, sort of supply demand standpoint, there's a lot of, portfolios, people monetizing into a market that has come back stronger than I think people were expecting. And the buyer universe, if you assume, now we closed 6 add-ons during COVID. Our healthcare guys closed a new platform. So we continue to deploy capital, but there are many funds that did not, just sat on the sidelines, and that's perfectly understandable for 2, 3, 4 months. Look, our business is predicated on the ability to deploy capital in many respects. And so there's pent-up demand on the buy side, and we're seeing, sort of many sort of middle market transactions being, bid up and aggressively chased beyond what it was the last 2 years, which was something Chris and I would probably agree was we had not seen it that intense, in our previous 20 years or so. So I look, exactly. It's surprisingly robust. Again, 2 months ago, I would have predicted there would have been a lot of activity, like what I consider hamster wheel activity, because that's what deal people do. Myself included, but it's not going to result in a lot of closed deals or a lot of, capital deployed. I was wrong. It actually will result and has already in closed deals and capital being deployed. So I'm, again, cautiously optimistic, other than having to now deal with robustness of activity and inflated values and people not taking COVID discounts. And in some cases, the advantage businesses want to get paid for COVID for next year, even though their businesses are going to revert. So, it's an interesting dynamic.
Yeah, I go ahead.
No, sorry. Do you have comments on how, what kind of deal flow, what COVID has done to deal flow, and what kind of deal flow are you seeing out there?
I would echo Brian. I mean, it's a frothy market right now. I mean, I would say, we anecdotally, I've heard people are seeing not as aggressive. The private equity seems very aggressive right now, and perhaps the strategics are not quite there, but they're still very frothy from a strategic's perspective. And I personally would say that in our pipeline and the businesses we're selling, we're seeing a ton of strategic interest. So when I say anecdotally, I mean, I've heard that in the marketplace, but I haven't really seen it myself. I'm seeing sort of a frothy market across the board right now. As Brian referenced, I think a lot of folks are worried about structural changes, both to the tax code and the regulatory code. I mean, if you look at the betting markets, you know, and the polls, you know, it looks like we're going to have a new administration and a new tax code next year, right? So we have seen a lot of corporate carve-out activity. Thinking off the top of my head on the stuff I'm working on, it's probably 80% carve-out right now. We're closing an owner-operator deal right now. You know, we did take an internal focus in second quarter, and it wasn't really because we were worried about buying businesses. I mean, after the COVID stuff started to settle into the new normal, we became very interested in deploying, but we ran into a buzzsaw, I'd say, a little bit on the multiples. You know, we were seeing, you know, in the past, I would say that we generally experienced a pretty significant multiple arbitrage when we would buy a business at 10 in EBITDA and sell it at 20 in EBITDA, between what the middle market would pay and what we could buy in the lower middle market. And there still is some multiple arbitrage there, but it is starting to compress. There's a lot of money chasing a lot of deals, including the small middle market, and we are seeing most clean businesses in the specialties at a 10x, you know, whether we're buying or selling. And that is a paradigm shift that I think was already really starting or going that direction before COVID. But like a lot of other trends in business and business-wise and social-wise, I think COVID's just accelerated trends that were already there and made them just, if it was going to be somewhere in 5 years, it's actually here now, including, you know, asset appreciation, commoditization of generalized private equity groups, down to little things like, look, we're doing meetings digitally instead of in person. So other aspects of deal flow, you know, we have 2 deals under LOI. One will close the next couple of weeks. I mean, we did take an opportunity to focus internally, really build our business development, institutional disciplines, our operating partner interface disciplines, focus it on building the pipeline, and it's paid off. You know, the challenges, as we've said, are, you know, we're doing everything remotely. You know, we're doing tours remotely, we're doing diligence remotely, and asset prices are very high. And as Brian said, people who are taking it in the chops from a revenue perspective are not willing to take a COVID discount. And certain people are having add backs to their EBITDA saying, well, but for COVID, we would have made 10 million bucks this year, so pay us for that. And it's, well, okay. You know, but for your product being a piece of garbage, you would have made $20 million this year. So, you know, I'm not paying you for that. So, again, it's been interesting in how certain things, it has had an accelerative effect on certain inflated trends, both from an earnings perspective and from a valuation perspective. It's had a depressive effect, obviously, on certain earnings issues, but not really on any valuation issues I can see, outside of sectors that, you know, typically are cyclical, like commodity and oil and gas.
So switching gears a little bit and talking about private equity in chemicals more specifically, right? If we look at like private equity investing in the chemical space, let's say 5-10 years and more in the middle market space, right? There have been a few sectors that have gotten a lot of attention, right? Lubes, lubricants, coatings, adhesives, sealants markets, right? There have been some of these segments where there's been a lot of focus. Do you see other interesting areas which will get similar focus in the next 10 years? Or are there still legs in the areas that has seen a lot of investing over the past few years? Chris, maybe we'll start with you this time here and then go to Brian.
I think there's no doubt there's still legs, at least from an asset inflation perspective. You know, the sectors you mentioned are still going for very big multiples. A lot of interest, especially from a PE perspective, right? The only things I'd ask that we've seen I've seen recently are life sciences and electronic chemicals have been taking off. Life science businesses, electronic chemicals, have been going for for multiples that are, you know, even in excess of the inflated values we've been talking about. They've been really going. A lot of demand around that, a lot of demand from private equity. We've been seeing generalists showing up at smaller life science businesses where they, you know, I don't think they even understand what the product or process is or does. But you know, besides those two, I don't see, you know, I see cyclical markets, cyclical products and commodity products perhaps being subject to some devaluation in certain areas or sectors, but the markets you're listing plus life sciences and electronic chemicals, I don't see any pullback at all. Not in a valuation perspective or a deal activity perspective, but you know, I have a fairly limited lens.
Brian? Yeah, so I agree with Chris on his characterization there. I mean, I guess I would say there have been some advantage sectors in COVID that probably will persist. I mean, maybe not at the level they were the last 6 months, but if you think in particular sort of sanitation and sanitation type products and chemicals, I mean, we've seen some hockey sticks there. And the question then becomes, what's kind of new normal? Where does it moderate to? It's not going to go back to its pre-COVID level. I think we all agree on that, but is it going to be 10x that it is now, or is it going to revert somewhere in between? And then how do you value that? So we've seen that. And then I think, again, from a PE perspective, the resiliency of certain segments, I think packaging in particular, which, you know, is really heavily invested by private equity, including us. And a lot of the, if not the finished packaging, you know, sort of food packaging, which has been very robust. Even a lot of the, you know, the polymers, the other enabling materials for finished packaging, I think those will continue to be highly sought after and valued assets because of the resiliency there. So I'd say that on the sort of positive side. On the negative side, look, oil and gas, you know, you draw your own conclusions there. I mean, I think private equity's been burned so many times for that. I just, you know, question how much institutional private equity capital will chase that sector, even as demand inevitably picks back up. And then I just look at it similar to Chris. I think some of the markets you mentioned, I think of them as, you know, some of the case markets, coating, adhesive, sealants, elastomers. I put those more broadly in the specialties area. Yeah. Continued robustness, no slowing down, fragmented markets, buy and build opportunities, kind of the things that private equity sometimes is looking for. I think those will persist. And again, Chris alluded to this sort of reshoring concept. I'm a believer in it at a lot of levels. And the opportunity set as a result, I think, is in the early stages. You know, some obvious things, APIs, but some knock-on effects of that as well. I think in businesses supporting that, I think ought to be investable here in the, you know, the midterm. So you know, just some ideas.
Thanks, Brian. That's helpful. You know, if you step back and take a look at what's happening in the chemical industry, right? And so, for example, if we look at the projects that we are doing for our corporate clients, right, operators, producers, a lot of them have a very strong sustainability, recycling, waste management, circular economy flavor to it, right? Is that an area where private equity has a role? A lot of that is like early stage technology development, right? Commercialization. Do you see that as a space where private equity has a role? And Brian, maybe here, I think maybe you should go first, because I know that you guys acquired one, at least one company that's in that realm.
Yeah, so the short answer is yes. I think absolutely. These are investable themes. If you think the broader ESG sort of construct, which is a, you know, label that a lot of people use, and in some respects is driven by our customers, Chris and our firm's customers, who are, you know, large institutional investors that have their own stakeholders and ESG considerations. That drives and follows down to folks like us who are deploying capital on their behalf. That said, there's really, I believe strongly, investable for private equity, not just early stage, for buyout folks, there are investable ideas. I mean, we bought a closed loop plastic film recycler last year. It's the largest in North America. Incredible business, growing hand over fist, unique business model, unique sort of purity of their recycled resin. And then they, started out as an agricultural film business. They've now branched into other applications because they have very high purity recycled resin. And it's a big business, right? And it fits sort of our threshold for investing and deploying capital. And that's just one example. I think that, businesses like that, that's called Revolution Plastics. There are many other investable ways from a buyout perspective, not just early stage, bioplastics and new things that are very venture-y. There are real, cash flow generative businesses and business models, driven around some of these ESG considerations.
Okay. Chris, how do you see that space? And also, private equity firms are increasingly they have been forced to get very responsive around ESG, kind of demonstrate to the investor base that, a lot of the investments are considering a lot of these ESG things. I guess, how does that affect the business of private equity as well? It's kind of two-part question there.
Yeah, it's a good question. I mean, I think, and I think Brian would echo this. If you come up in specialty chemicals, you really have to have safety and environmental in the front of your mind with every investment, and more importantly, with the governance of every company, right? When you look at it, and this isn't in the last couple of years, this has been since really 2000, 2002 for us. If you look at our monthly reports, our board meetings, our bi-monthly meetings, the first thing we talk about is environmental health and safety before we talk about financials or covenants or loans or anything else. Because, obviously the consequences of failure for us, particularly in the chemicals businesses, are much higher. Now, going to, deal flow, away from portfolio. And so that for us hasn't changed for us. I mean, that's at the front. We want to be, responsibly operated business, frankly, and going away from the altruistic motivations. Responsibly operated business is worth a hell of a lot more than an irresponsibly operated business. So it's to the direct benefit of our investors. In terms of businesses with a direct link to ESG, Brian's firm has certainly demonstrated there are business opportunities directly there. From our firm's direct experience, it's more sort of tertiary products within that universe. So think of an epoxy that goes into that binds materials that go into solar panels. Think of ingredients that go in water purification systems, ingredients that go into recycling systems. That's more what we see as the smaller pieces of those businesses. But I will say that in our deal flow right now, we're looking at a business that manufactures alternative fuels directly for combustion engines. I do think that the trends separating politics, the trends driving those things will only pick up. I think, climate change is essentially a scientifically accepted phenomenon that's going to take a lot of technology, innovation, and economic concentration to deal with, plus recycling, plus, a whole other mess of conservation measures. From a social perspective, I think you'll see the same things, although I think there'll be fewer actual industrial business opportunities around those trends. That's more in the consumer realm that at least my firm doesn't really mess around with.
Yeah. Excellent. That was helpful. So we as we try to wrap this up, right? One last question. Both of you guys have had very successful careers in private equity. I guess, what do you see as exciting stuff in the next, let's say, 10 years? Are there things that you, on the other hand, worry about, or is there stuff that keeps you up at night? Brian, we'll start with you.
I'm gonna answer it on the positive side. I don't want to think about the negative and things that keep me up at night, other than my puppy barking, my COVID puppy barking, right? Look, I mean, I remain excited about what we do at Arsenal and our sort of focus areas, because, and again, similar to Chris, and I think he probably shares the same viewpoint, it kind of goes back to the old BSF tagline around we make the things that, you know, that make things better. I mean, a lot of the enabling, the macro themes that are prominent today, whether it's, you know, automation, lightweighting, IoT, you know, energy sort of transformation, the emerging middle class, all these different huge macro themes that the large consultancies talk about all the time. You know, we are investing in and building companies that are providing those enabling technologies. And it's very powerful to see that the end result and, you know, see our companies and the stakeholders in those companies all being able to sort of effectuate those and enable those trends. So I remain excited about that. I think Chris probably feels the same way I do. We have a unique viewpoint through which to see this from what we do, and are very fortunate to sit in the seat. And that, I think, will continue on despite the vicissitudes of the private equity business.
Chris,
I would echo that. That was really good. Not actually, that was a good summary. That is what's exciting. I do think that the as we saw in the last fundraising cycle, and I would bet Brian did too, the world of limited partners and investors in private equity is starting to realize that the generalist sector is tough, and that differentiation really is a real thing. Having a competitive advantage in a process based on you know, having a focus, in my mind, particularly in specialty industrials, is a real thing. And I'm excited about the future in that regard, insofar as I think we still continue to have an advantage and will have a competitive advantage in these processes, while the rest of the market, I think, will begin to commoditize, or actually will not begin, continue to commoditize. From a direct firm perspective, you know, we have gone from a one-man band in the last 20 years to a machine with 21 people. You know, in no small part to respond to the challenges of inflated asset prices and the supply demand of capital versus number of deals. But, you know, I'm very excited by, you know, having a if you will, a real institutional firm with still an entrepreneurial bent. It's very exciting to watch. It's exciting to watch, you know, people, you know, really create a institutionalized, disciplined deal flow and transaction and portfolio management approach. Although it means that I have to follow the discipline too, which is sometimes a challenge. You know, challenges. You know, my challenges are more sort of societal and structural. I think we're in a great place from a business perspective and an institution perspective and an investment perspective. You know, I'm obviously concerned about you know, what appears to be a shrinking middle class, what that means for demand for products. You know, I have kids, as does Brian. I'm concerned about, you know, what the job market looks like, what the accelerated trends of COVID mean for kids going out and trying to find new jobs, where they will work, where they will find opportunities. You know, politically, I'm concerned about the rise of China and kind of, you know, the international decline of the United States. But all things that are enough outside my control that I can't lose sleep over them, right? Because there's nothing I can do about them. So, you know, from a firm perspective, I feel great where we are. You know, I think private equity is commoditizing. It's clear returns are going down. MOICs are going down, but I do think we've got as good a firewall against that as anybody, as I think does Brian.
Excellent, Chris. Thank you very much. Brian, thank you very much. I much appreciate both of you guys making time for us. Very insightful conversation here. We'll stay in touch, and thanks again.
All right, stay safe.
Okay, thanks for having me,
guys.
All right, bye-bye.
Bye, everybody.